Hello and welcome. Today I'm in the offices of Data Bank, an investment firm right here in Accra, and I'm here to speak to two astute gentlemen on a number of issues. First and foremost, the Bank of Ghana's monetary policy rate. What exactly does it mean for us and for the inflation rate? Where is it heading? Is it good? Is it bad? What does it exactly mean? We also talk about lending rates in the economy. How well are we doing? Lending rates are about 26%. Should we see them coming down further? What's happening? We'll discuss a bit about the banking sector also. Then we'll move on to talk about debt to GDP ratio. Yes, government borrowing again at the forefront of discussions. It's about 57%. Is that too high? Is that too low? What can we learn from these two gentlemen I'm going to speak to? They are economic analysts right here with Data Bank, an investment firm. So you know what? Stay tuned. Don't go anywhere. Welcome back. This is PM Express Business Edition. My name is Philip Nanfuri. And my guests are two astute gentlemen. Courage Mate, he's a senior economic analyst with Data Bank, and Kwesi Buti. He's also an economic analyst right here in Data Bank. Now we're going to look at exactly what the governor's rate cut means, from 17% to 16%. We know inflation as of December 2018 was at 9.4%. So anytime the Monetary Policy Committee of the Bank of Ghana meets, they review the health of the economy, then they come out with this rate. So what's the link between that rate and inflation? What is it exactly supposed to do? So I'll start off with Courage Mate. On Monday, we had the governor cut the monetary policy rate by 100 basis points from 17% to 16%. We've seen that over the course of 1 year, that's from January 2017 till date. We've seen the rate drop from about 25.50% to the current 16%. We've also seen inflation trend downwards into the single-digit ranges, and Bank of Ghana says they have a target of 8 plus or minus 2%. That's between 6 and 10%. One would argue that all is well and good. Is that so?
Well, broadly, yes. All is well and good, especially if you consider where we came from. And I would like to roll back the hand of time and remind ourselves of the fact that the last time we saw single-digit inflation was early 2013, and that sustained from the single-digit inflation we recorded from somewhere late 2010, and it remained in the single-digit until early 2013 when, because of the exit from then IMF program and the election excesses from 2012, things went back up. And then we had remained in double digits until then. And then we embarked on both fiscal consolidation and monetary tightening to ensure that inflation comes back within the band of 6% to 10%. So it appears the trend we have seen in the last couple of years has pointed to a positive direction. So on that count, I can say all well and good, but with a lot of caution to the outlook.
Okay, you mentioned the International Monetary Fund, the IMF, and us in 2010 coming out of an IMF program as part of the reasons for the single digit at that time, if I'm right. Given the current dispensation, do you think what we are seeing right now is as a result of the Monetary Policy Committee's actions or moves, or there's some influence coming from our IMF ECF supported program?
It's a combination of all these factors. And again, let me remind us of something that's happened when the program started. In 2015, when this current IMF program started, we noticed that inflation was in double digits and running upwards at the time. Then also you look at the policy environment, and you could see the lack of credibility, particularly with monetary policy. There was a lack of credibility, and essentially that's why we went for the IMF program. How do you notice this lack of credibility? In 2015, when the IMF program started, we had market interest rates, such as the short-term rates like the 91-day interbank interest rate and so on. They were around 24%. But at the time, we had the monetary policy rate, which is supposed to be the punitive rate, being below the 24%, it was at 21%. At that point, the signal is that you can get liquidity cheaper from the central bank than from the market. It should have been the other way around. So given that scenario, monetary policy had lost credibility at that point in time. But since the program started and the analysis of the market, they had to start adjusting the policy rate to make it more credible. And then we saw the policy rate going back up to 26% and was maintained at 26% for 12 solid months, 1 year. So that over that period, it had tightened the economy or money supply to the point where aggregate demand was restricted and the demand side pressures were contained. And then that started slowing down the rate of increase in general prices. And so we saw inflation coming down. In addition to that, we saw a complementary fiscal policy, in other words, government budget operations, complemented the efforts of the central bank to bring down inflation. You recall that in 2017, for instance, there were a lot of taxes that were knocked off. You also recall that we saw a reduction in the special petroleum tax. All these policy measures from the fiscal side of things helped to reduce the cost side to inflation and helped non-food inflation down. And broadly speaking, the headline inflation trend tends to mimic the non-food inflation trend. So as non-food inflation started coming down, we saw a corresponding decline in the headline inflation. So I would say it's a combination of everything. Credible monetary policy helped by the start of the IMF program and as well as complementary fiscal policy.
Kwesi, Carrie has just given us some perspective. We've had a good balance between monetary policy and fiscal policy. The Monetary Policy Committee meets on a bi-monthly basis, so that's 6 times a year. The next meeting is in March. In your estimation, what do you think are the risks? Because right now, Carrie argues that all is well and good. What do you think are the risks we should look out for? What do you think can throw out this inflation, single digit out of gear, back to the double digits we just spoke about? What do you think can throw us out of gear?
Well, the Banks of Ghana primary objective, we all know, is to ensure price stability. And that is all they try to do with their policy tools, all the policy tools available to them. The MPR is just one of those. And then so they analyze really what is happening to the outlook for inflation, expectation, underlying inflation, and all of that in coming out with a decision. Now, for this particular decision, I think all the arguments they adduce to why they reduce the rates are factual and valid. Yes, inflation has been on that downturn since 2016, all the way to where we are now. Underlying inflationary pressures, which is actually the correct measure or the appropriate measure of inflationary pressures, and that may determine the path of monetary policy, is also trending down sustainably. Of course, it's still, that one is in the double digits, yes. I think it printed 10.4 the other time, but then it's on a sustained path of decline. So on that score, you can say they are justified in reducing the monetary policy rate as a means of stimulating growth by easing credits somehow. But the reason we thought, or I'm thinking that the decision probably is rushed or probably should have been delayed for March or even May, this policy meeting, is that at this time we are seeing pressures on the market, pressures that could reasonably threaten inflation. Things like currency depreciation. I think year to date, the CD has fallen, about some 2.5 or so % versus the dollar. Over the last decade, I think that is the worst start to the year for the currency. And of course, in the last 2 days, we've seen it stabilize around that around 8 to 9 level, right? But then we know that 2.5% depreciation in just less than a month is an anomaly that we don't know what it's going to look like, especially at a time where Bank of Ghana has a lot of reserves, but over the 4 weeks in this year, we haven't seen enough injection of those effects in the system, particularly at a time where the external market is not looking external financing conditions is not looking favorable for EM and then, of course, Ghana. And then so the offshore bond investors who normally will look at our longer dated bonds as a source of injecting liquidity into the system are no more interested in duration. They are looking more at the short-term end of the market. So FS supplies are kind of tight. And the banking system itself is also not releasing as much credit into the system. So those are threats, and inflation is elevated. At the present level, if you want to annualize it, you're talking about some 38 plus depreciation end of year. Now, if that turned out to be the case, then the pass-through from currency depreciation to inflation will actually shock inflation to the upside, which is a risk I think they have taken too lightly. Another thing, the fiscal outlook. Yes, we know we have behaved well in the last 2-3 years under IMF supervision, but we know the IMF will soon lift down. Yeah. The program is ended. We're waiting for the final review somewhere in April. In 2018, the fiscal target said, I think the fiscal deficit at 3.7% of GDP. We ended the year at around 3.8% of GDP. And of course, let's be fair, we will know the size of the GDP in April. Then we can know the actual fiscal deficit. But then tentatively, what we are told is 3.8%. That is how we ended the year. We've exceeded the fiscal deficit target. And then that is under IMF when we are waiting for a final review to be passed or, get the final assessment. Now we are outside IMF in 2019. We are executing an expansionary fiscal budget that would generate all the expenditure pressures we could see in the economy to stimulate again demand to a certain level. And if productivity doesn't grow commensurate with that stimulation in aggregate demand, there could be pressures, liquidity pressures in the system that could trigger inflation. And then that is what I think, or those two principally, is what I think the Bank of Ghana should have been a bit more cautious about in deciding the rate or to cut the rate at this very meeting. We all know, and as I said here, we know that the alignment between the money market rate, the interbank lending rate, and then the T-bill rate, and where the policy rate was, as you compare it to where inflation is, we know it is not optimal, it's misaligned. And then we believe that there is room for even MPR to come lower. But the timing of such reduction is very key, so as you don't trigger a reversal in the trend we are seeing already for inflation. And so those are the risks, the currency depreciation and the risk exposed to inflation, and then the fiscal developments and then potential impact of IMF exiting and then the ramifications it might have for inflation going forward is what I think they should have been looking at. I think probably we are jumping ahead of ourselves. Let's not forget we have a history. Yes, a lot of legal provisions to help improve fiscal performance going forward. Fiscal Responsibility Act, capping fiscal deficit, capping debt to GDP ratio, and all of that are in place, okay? But we know, and then the market hasn't won that confidence from government, or the government hasn't won that confidence of the market yet. He talked about we having single-digit inflation for over 36-month period, but then it reversed ultimately. Now, within this period, we are just around 9.4%. We are just close to the upper band. We haven't even moved to the middle level, let alone think of sustaining it there for a reasonable period. So we can't get excited and then ease monetary policy excessively to the point that it might trigger some pressures again. And those pressures could be real. And that is why I think they needed to have exercised some caution in cutting the rate. That said, the environment and we think the alignment of the market will permit that. It's just the risk that I think should have been looked at again.
Okay, you've mentioned the currency depreciation, and Ghana doesn't operate in a vacuum. I want to take us beyond the shores of Ghana. Last night, we saw the Federal Reserve putting a pause on their rate increases. One would argue that this is good for us because of the fact that, you know what, this rate hike path they were on has now been subdued. So therefore, all things being equal, investors should still be within our market. Is that argument still valid, given what the Federal Reserve did last night?
It is valid. Yes, they held the rate and they adduced a lot of reasons. I think part of the reasons they gave, while growth is still looking good, employment is looking good, private consumption and then private capital, stuff like that are all looking to the right direction. They feel the resultant inflation is not picking up as everybody anticipated. Inflation, both the PCE and then core, their headline inflation is still just around that 2% target they have. And then so they are looking at the threat to inflation as a result of the fiscal development. Even though the indicators are still looking good, they feel it doesn't threaten inflation going up so much. And particularly at the time where there is a lot of talk about recession coming up soon because the global economy is slowing down and you know its ramifications, the transmissions to other sectors of the economy and then how that may impact even the export volume, job creation, productivity, and all of that across the sector. So they are wary about that. That is why they won't hike excessively now, just to monitor the development. But that said, the sentiments toward EM seem to be improving, but not as fast as we would have loved. Face it, rates are higher in the US now than they were some months ago. So, and nothing significantly has changed in EM. So they are not yet looking at market yet, even though they are easing their stance on the risk they perceive in our market. So you would see from the trades we're seeing on the market that Eurobonds, which is denominated in the USD, as what they seem to be preferring now to the local currency bonds. It will be a matter of time until maybe the next Fed meeting also rate is held, and then the indications that will come thereafter when it shows that maybe this year we might have minimal cuts. Maybe the two they are talking about may not be two after all, maybe one. Maybe that is when it might trigger them to actively look at local currency debt in AM and probably Ghana benefiting. So it is not straightforward as to whether the outlook now in the US and holding this rate alone is enough to bring those guys back to our market. It will depend on the development going forward. EU, yes, are talking of ending, they have ended their QE program, the quantitative easing program, and then talking of rate hike already. But would that happen this year? I don't think so, because the inflation build-up and then the growth levels they are looking, the economic level of economic activity and employment creation that they are looking for to actually warrant inflationary pressures, and that may bring about rate hike, it hasn't picked up to the level yet. So all of those things are there. So the EU market may be the one that presents an option for us that if rates are not going to go up immediately, they will be looking for elsewhere. Hopefully EM might be an option for them. But they are also open to the other regions, the other markets that probably may present better proposition. That is why we need to be careful with our rate decisions at this time. Once you are easing your monetary policy rate, what you are effectively doing is you are bringing down market rate as well on government bonds, on the money market and all of that. And then if you are seeking to attract those guys, and I'm not advocating for we giving them very high rates, but if you're seeking to attract them and then your currency is under pressure and then they are not coming to inject that liquidity, the last thing you want to do is to even bring down rates. Because already you are not attracting them. And then you need to put mechanisms in place to stabilize your currency that gives them confidence to take the rates that are on your market. And it is that demand, maybe excess demand that may come from them as a result, that will bring about the stability in the currency and eventually reduce the rates on the market.
Okay. Courage. Kwesi has mentioned rates, and interest rates are a topical issue in the country. And we are a debt-driven economy. You would argue with me that that's right. Debt-driven in the sense that people go out looking for funds to borrow rather than go to alternative sources, private equity, venture capital, and then equity markets, and so forth. So anytime the Monetary Policy Committee meets, to the local man on the ground, he's happy because it sends a signal to what his banks might give him. We've seen that the monetary policy rate has come down over a year's period from 25 to 16. Over the same year's period, interest rates, average lending rates, according to Bank of Ghana's own data, is from 29 to 26%. Someone who asks this question, you know what's going on? Somebody who doesn't understand monetary policy and its influence on interest rates to aggregate demand and so forth. What is going on? Can you break it down for us? Why do we see this disparity between what the monetary policy is doing and where the interest rates are today?
Okay. To be very basic, when the central bank sets a certain interest rate they call the policy rate, it serves two purposes. One is to signal the risk to the outlook. So when the policy rate comes down, it is signaling that in the short-term outlook, 3 to 6 month outlook, the risk have reduced. And so if you are parting with money and you want to charge a risk premium, you should reduce your risk premium. Then secondly, it is also the cost of funding the commercial banks when they need sort of overnight liquidity to fund their operations. Because when commercial banks resort to central bank as a lender of last resort for liquidity, they have to pay a certain cost. And the policy rate sets the benchmark for the cost they pay when they have to go to the central bank. The whole idea is to make sure that commercial banks are able to manage their liquidity such that they don't need extra liquidity from the central bank. But if you have to do that as the lender of last resort, then be prepared to pay the price, which is the policy rate, plus probably a corridor or a margin. So when the policy rate comes down, it means that commercial banks can access relatively cheaper source of funding from the central bank. And that should also be passed on to individuals or businesses when they approach commercial banks for credit, right? Because the cost of funding has gone down. So the charge you also have to levy on credits or loans should also come down. Has this happened? If you look at the data, you realize, and as you said, you realize that it has happened, but not to the full effect. Why have we not seen a commensurate or a significant impact on lending rates? There are a number of reasons. One is the competition for funds on the market.
Okay.
We have a situation where private sector need the funds. We have a situation where public sector, that's the government, also need funds because government spends more than its revenue. That gap has to be financed by borrowings, and they borrow from the same market. And they are prepared to pay a certain amount of interest to borrow that amount. Generally, governments tend to pay or be ready to pay higher than the private sector can because the private sector is profit-oriented. So if your cost of operation is going too high, you may as well scale back on costs and maintain a certain level of profit. So if the cost of credit to the private sector is too high, it becomes difficult for the private sector to get it. Government is almost always able to get it at certain levels. And so that competition restricts the ability of commercial banks to bring down the rates, the lending rates, because if government is certain to pay a certain amount, and that is risk-free because government will always pay you.
Back,
it can even print in the worst-case scenario to pay you back. But the businesses, once they go bankrupt, then your credit is, your loan is also going in default. So it's preferred to give it to a risk-free borrower who is even prepared to pay a certain height of interest rate. So that is one key reason.
Okay. I want you to hold on for the explanations for me. I want us to take a quick break here. This is PM Express Business Edition. My name is Philip Namfuri. My guest, Courage Mate, Senior Economic Analyst, Data Bank, and Kwesi Boti. He's also an economic analyst with Data Bank. We'll be right back. Welcome back from the break. This is PM Express Business Edition. My name is Philip Namfuri. Just before we went on the break, we're looking at how exactly the monetary policy rate affects lending in the economy. Anytime I want to go and borrow from a bank, I'm disturbed by the cost on the loan I'm going to take. Before even this, you're going to pay some fees, as we saw from Bank of Ghana's data that came yesterday on bank charges. It's quite a lot. So Courage is going to continue explaining to us why exactly the monetary policy rate and interest rates in the economy are not at a one-to-one balance. Courage, please continue for us.
Okay, so I started by talking about the competition for funds and how this competition prevents the decline in lending rates that are charged private institutions when they go for loans. There are two other ones I want to quickly touch on. That is the macroeconomic risk or environment. You see, one of the key risks that lenders or banks consider in determining what lending rates to charge, particularly the base rate or the reference rate, is the inflation risk. Because inflation erodes the value of the money that you part with. So if you are parting with any money, you want to be able to factor in the cost of inflation or the risk that inflation will erode a certain portion. The higher the rate of inflation, the higher the inflation premium or the risk premium you will charge, right? So over the course of the years, we have maintained double-digit inflation. Admittedly, now we are in single digits. But there's also a question of sustainability. Do the banks trust that we can sustain it at the single-digit level for a long time, particularly over the duration of the loans that they are giving? Otherwise, if it turns the other way around, then they are likely to earn a real value which is less than how much they lent out. So they will try to forecast what inflation would be despite what it is now. And because they are not very confident that it will remain low and in single digits, they are less likely to reduce the inflation premium significantly. And that will also prevent a significant decline in lending rates. So on this particular account, there is a call on monetary policy as well as government to ensure that we institutionalize low and stable inflation, because it is only that time that banks and lenders will begin to form the expectation of continued low inflation, then they can sufficiently reduce the inflation premium they charge. So that's the second point, the macroeconomic risk. Now, the macroeconomic risk would feed into the third point, which is credit risk. So there's a risk that the particular borrower may not repay the loan, may go into arrears, the loan may go bad, depending on your type of business, right? So the lending rate we see is not one and the same across the board for every borrower. There are some bit of discrimination based on the risk associated with your investment plan or your business operations. And so depending on the kind of business you do, the credit risk associated with you can be higher or lower. And that also determines the kind of interest you pay. A good example is a situation or in recent times where we have high NPLs, non-performing loans. And these are loans that could likely go bad, right? And because of these, as a banker or a lender, you don't feel confident to keep lending because you have a significant percentage of what you've lent out at risk of going bad. And so you want to take caution. And the way to signal that caution is to hold the cost of credit high so that not everybody can come for it. Only those who really need it for a viable investment will come for it. So these are all the dynamics that play and work into the inability of lending rates to come down as fast as the policy rate is coming down.
Kwesi, Courage has given us some good answers. One, the cost of funds, if I could infer from what you said, your first point. So government and private sector competing. But we've seen that Treasury bill rates have been coming down, which is signaling that government's cost of borrowing is reducing. Then on the front of the macroeconomic environment, we've seen that, okay, inflation has been trending downwards over an appreciable amount of time. The third point has to do with the credit risk. And we've seen that, yes, though non-performing loans are still high, the rate of growth, if I'm correct, from Bank of Ghana's last banking sector report, has also reduced, given the reforms that have gone in the sector, as well as the write-off of some loans to about 1.something billion Ghana cedis from the Bank of Ghana. If these are all the points, then we should expect interest rates to drop. Is that a sound argument?
Ideally, that should be it. But let's understand the structure of our economy also wouldn't permit that ideal situation. And I think the points he made are very, very valid. Let's look at it this way. The reason interest rates are sticky and may not come down as much as we all desire has to do with a lot of structural issues around us. The risk associated with an individual is just your ability to repay. But the banks have even a bigger problem of identifying people, where they live, where you can trace them to, and then a lot of dishonesty in the system. These are attitudinal and structural issues locally. So it's not as though, and I guess the policy stance or the Development Bank of Ghana brought about the, what is it called, the reference rate.
Yeah, Ghana reference rate.
The reference rate is supposed to kind of make the base rate look like market determined. And that's how come you see in there, the policy rate is in there.
Yes.
In there, you have the 91-day bill rate.
Yes.
And then, of course, you have the interbank lending rate. They're weighted, appropriately to reflect the market situations. But all of that notwithstanding, I need to be sure that this individual A I'm lending to is going to do X, Y, Z with the business and with his business and bring back my money. And then that when I'm looking for him, I can find him. And one big development we have seen with this government is the introduction of digital address, but to what extent have we pushed it?
Do you feel it has worked? Do you feel it has improved?
That's why I'm asking, to what extent have we pushed it? Do you know if you are directing people to your house, do you give them your digital address or you still say, pass by yellow container, take left, take right? Because those were the things we were trying to avoid. But you see, if I am able to determine that this is individual A, if I'm looking for him, I'll find him here, then that risk that will maybe associated with not finding you is knocked off. Rates can come down. So I'm staying away from the economics and all of the things he said to look at the structural issues. We have an agriculture-dominant economy, a lot of people employed in there, but it's not producing so much. Now, if banks are supposed to lend to those sectors, which they don't do much anyway,
yes,
you are factoring the fact that there could be drought this year. There could be, what is it called, army worm invasion this year that could destroy everything. And so all of that feed into how much they charge you. So on an individual basis, some people who tick all the boxes may get very high, low rates, whereas people who don't satisfy all of them reasonably may get very high rates. So that rate you see on the market, that is around 27 now, is an average rate for the whole market. So for Bank A, you give different loans at different rates, right? The average of all the people you gave loan to in a given category as what you are seeing. So the economics of it tells you that rates should come down probably lower than they are now, because if your cost of fund, or let's say your punitive rate from the central bank is now 16%, it doesn't make sense why you should offer 27 or so percent when we know that the rate on deposits or returns on the interest on deposits is just around 8 to 9% for even those who are generous enough, and a much lower even for the bigger brands. And we know fixed deposits are in the 20s and 19s now, and all of that. And those represent, I think fixed deposit maybe as your highest cost of fund. So why do we have to have 27, 30, 31 for some banks?
Exactly.
It is the structural issues in the economy. That is why I think this issue should be tackled head on. The initiatives shouldn't be brought for the sake of bringing them. You don't do digital address for the sake of it. You do it and follow it through. I mean, how many of our banks have actually requested us to submit our digital addresses? How many of us have even submitted, and which bank decide that I'm blocking your account because you haven't submitted this? I mean, if those things are strict enough, you get people to comply to even the reforms you are putting in place, and it reduces the risk. In Ghana, there is a credit reference bureau, or where you are supposed to go and log all your clients you've given loan to, so that anyone who, if they go to a bank B applying for loan, you can just go there and see the person's credit record. Question, do banks even submit it? One, do other banks even rely on that information? Or to what extent do we ensure compliance to these things? It is when these ones are in place, and I just search one individual, and then I find out, okay, he took loan from Bank A, Bank B, Bank C. It was a 2-year loan. He paid in 6 months. It was a 5-year loan. He paid in 3 months. Or it was a 1-year loan. It took him 5 years to pay. Then I'm able to adequately assess your credit risk, and that is what will bring down the rate overall. But if those things are not available, yes, policy rate will come down, but then we will not see a commensurate decrease in a market rate because of these structural issues.
Okay,
I think I need to emphasize a point. I made mention of credit risk. He mentioned something that is very important as an important component of credit risk assessment, which is the credit history.
Okay.
And I think this point must be emphasized, because when borrowers approach banks for loans, one thing we need to know as borrowers that approach banks for loans is that the banks have a database of our credit history. So if I'm Bank A and you are Bank B, and he approaches me for a loan, after all the loan application is analyzed and the loan is disbursed, every behavior after then is tracked, so that the way you pay, if you go into arrears 3 days, 5 months before you come to pay, every time you go into arrears before you come to pay, or every time you pay us at when it falls due, it is recorded in a place called the Credit Reference Bureau. And the banks have access to this database. So when the same borrower who took loans from me comes to you, you can check to see if he has loans in other places and how is his behavior. Now, a borrower who has loans across various institutions is a risky borrower and would definitely pay the risk.